Hello, and welcome to this video on investing your first $1,000. Investing can be daunting, especially if you're just starting out. But with the right approach and mindset, you can make your money work harder for you and achieve your financial goals. In this video, I'll share some tips and insights to help you make a well-informed investment decision. Be sure to like, comment and subscribe for more content and turn on the notification bell so you can be notified when we drop another video. Let's dive right in. Step 1. Assess your financial situation. Before making any investments, it's essential to assess your financial situation. Look at your income, expenses, and debt to determine how much money you can afford to invest. Take into account any emergency funds and other financial goals you may have. In this part of the video, we'll go through some examples of how to assess your financial situation and create a budget to help you plan for your investments. Step 2. Educate yourself. The next step is to educate yourself on different investment options. There are many ways to invest your money, including stocks, bonds, real estate, and cryptocurrencies. Real estate refers to land, buildings, and other structures that are used for residential or commercial purposes. Real estate can be a tangible asset that generates income through rent or property appreciation. Real estate investors can purchase properties directly or invest in real estate investment trusts, REITs, that own and manage various types of properties. Pros of investing in real estate. Tangible asset with potential for long-term appreciation. Rental income can provide a steady stream of cash flow on a long-term basis. It can also be used as a hedge against inflation. Cons of investing in real estate. Requires a significant amount of capital to purchase a property. Property management can be time-consuming and require specialized knowledge. Real estate values can fluctuate with the economy and local market conditions. Cryptocurrencies are digital or virtual currencies that use encryption techniques to secure and verify transactions. Cryptocurrencies operate independently of central banks and are decentralized, meaning they are not controlled by any government or financial institution. Bitcoin, Ethereum, and Litecoin are some of the most popular cryptocurrencies. Pros of investing in cryptocurrencies. Decentralized, meaning they are not controlled by any government or financial institution. It offers full anonymity and privacy in transactions. Potential for high returns due to volatility in the market. Cons of investing in cryptocurrencies. There's also high volatility and risk of significant losses. Lack of regulation and security risks. Limited acceptance and usability as a form of payment. Stocks represent ownership in a company and are bought and sold on stock exchanges. When a company is profitable, its stock price can increase, providing investors with capital gains. Some investors also receive dividends, which are a portion of the company's profits distributed to shareholders. Pros of investing in stocks. There's potential for high returns due to the long-term growth potential of successful companies. Easy to buy and sell on stock exchanges. Diversification opportunities through mutual funds and exchange-traded funds (ETFs). Cons of investing in stocks. High volatility and risk of significant losses. Difficulty in evaluating individual stocks and predicting future performance. Exposure to macroeconomic and political risks that can impact stock prices. Bonds are a form of debt that companies and governments use to raise capital. When an investor buys a bond, they are essentially loaning money to the issuer and receiving interest payments in return. Bonds are generally considered less risky than stocks and can provide a steady stream of income. Each option has its own risks and rewards, so it's important to understand the basics before you invest. Read books, blogs, and articles on personal finance and investing to gain a better understanding of the various investment opportunities available. Step 3. Start small and diversify. Let's talk diversification. Now, you might think diversification means having a variety of snacks in your pantry, but in the world of investing, it means having a variety of assets in your portfolio. Think of it like this: if you had a bunch of friends who all loved pizza, would you invite them over and only order one kind of pizza? No way. You'd want to make sure everyone gets a slice of their favorite kind. The same goes for your portfolio. You don't want to put all your money into one type of asset and risk missing out on potential returns. So, what kinds of assets can you diversify with? Well, there are stocks, bonds, real estate, commodities, and more. It's like a buffet of investments. You want to fill up your plate with a little bit of everything to make sure you're getting a balanced meal. One easy way to diversify is through index funds or ETFs. They're like the lazy Susan of investing. You spin it and get a little bit of everything. Plus, they're usually low cost, so you won't be spending all your dough on fees. When it comes to asset allocation, it's like building a sandwich. You want to make sure you've got the right balance of bread, meat, cheese, and veggies. In investing terms, that means figuring out how much of your portfolio to allocate to each asset class based on your risk tolerance, investment goals, and time horizon. So, remember, diversification is like having a well-stocked snack cupboard or a pizza party with all your friends. You want to make sure you've got a variety of assets in your portfolio to help protect you from market volatility and potentially earn higher returns over the long term. Step 4. Set realistic expectations. It's important to set realistic expectations when it comes to investing. Don't expect to get rich overnight, and be prepared to weather market fluctuations. Investing is a long-term game, and it takes time to see the benefits of your investments. However, with patience and discipline, you can achieve your financial goals over time. Step 5. Seek professional advice. If you're not sure about where to invest your money, seek advice from a professional financial advisor. They can help you develop a customized investment plan that aligns with your goals and risk tolerance. A financial advisor can also provide guidance on tax implications, asset allocation, and retirement planning. However, be aware that financial advice may come with a cost, so weigh the pros and cons before making a decision. Investing your first $1,000 can be a great way to start building your wealth and achieving your financial goals. However, it's important to take the time to assess your financial situation, educate yourself, start small and diversify, set realistic expectations, seek professional advice, and monitor your investments. Remember, investing is a journey, and it's crucial to develop a well-informed plan that aligns with your goals and values. Thanks for watching. Be sure to like, comment, and subscribe, and be sure to let us know on which investments piqued your interest in the comments. See you in the next video.